We focus on total return for shareholders, but income is a very, very important component of that. We're not a high yielding trust. We currently yield about 1.5 to 1.6%, but over the longer term, income has been a significant component of total return for our shareholders, comprising around a quarter of total return in recent decades. We've got a very strong track record in terms of dividends. Firstly, paying dividends. We paid a dividend every single year since 1868, so 150 consecutive years of dividends for shareholders. And in each of the last 47 years, we have delivered a rise in dividends year on year. And in most instances, since 1970, that dividend rise has been in excess of inflation. Over the past 10 years, our dividend has grown in the order of 78%, which equates to 5.9% per annum, which is well ahead of inflation, which was only 2.4% per annum over that period. One of the great advantages of the investment trust structure is the ability to set aside reserves in good times to pay out dividends or supplement dividends when perhaps times are less good. So we have over the years accumulated a very significant revenue reserve, around £91 million or 17 pence per share as at the end of 2017. And the ability to build up those revenue reserves when we're actually earning good levels of income means that during lean times we can draw down from that reserve to supplement dividends for shareholders. And that's really one of the, I think, the key benefits of the trust structure, and really has enabled us to pay a rising dividend stream for each of the last 47 years. Well, as I said, the trust structure is a real advantage, but we obviously need to make sure that underlying income stream for the companies we invest in is sufficient to deliver rising dividends for shareholders over the longer term. We focus on equities, listed equity and private equity, and we invest into a range of underlying investment strategies on a regional basis and on a global basis. Many of those strategies focused on strong growth and free cash flow. Most of the strategies don't actually have an explicit income focus or yield target. One exception to that is our global income component of the portfolio, which comprises about 10 or 11%, and that's got a yield pickup, and that enables us to navigate between opportunities which are more focused on capital return and some which are more focused perhaps on generation of income. So this focus on total return for shareholder and the ability to deliver it in a manner which means that we're not chasing income for its own sake, means that we should deliver the best returns for shareholders while at the same time continuing to deliver rising income through time. Well, we focus on total return, as I said, and our smaller companies allocation, which we have as a distinct strategy in the portfolio, has a yield which is broadly in line with the global market for large cap stocks. So it's not a yield play per se, but it's actually been a great area for us in investment terms, again with that focus on total return, generated very strong capital gains for us in recent years without sacrificing on income. Well, I think it's difficult to argue against the fact that the market is trading at relatively elevated levels of valuation. So it's not as easy as it was several years ago to find value in equities. That said, we do think that the fundamental backdrop remains relatively sound. The global economy is still growing relatively strongly. there's a synchronized upturn. Inflation rises are relatively modest, and we do expect rate rises and withdrawal of liquidity by central banks. But again, that's going to be relatively modest. So the growth picture looks reasonably good. Earnings growth is coming through, and that's supporting equity markets. So on many metrics, actually, the strength in earnings has exceeded the growth in prices over the past year, which means that markets are trading at lower multiples today than a year ago. So valuation is not compelling, but certainly not excessive in our view. We were expecting volatility to pick up, and certainly that's what we've seen over the course of the first quarter and into the second. In our mind, that rising dispersion, rising volatility in markets doesn't necessarily signal the end of the bull market. Markets would like to remain choppy, but we still think that there is more to go for from here, albeit we have to recognise clearly we're closer to the end than the beginning of the economic cycle and indeed the bull market.